everyone, it's Jefford again from Rubik's Academy. Now, today we're going to look at a stock, and I've actually gotten sort of some feedback that I shouldn't be doing technical analysis so often because in stocks they look at FA more. I totally agree with that. Now, I just want to clarify that the reason why I haven't done any fundamental analysis is because I was actually consolidating some statistics for us to analyze. All right, and I was also looking at all the interesting companies where the stats would actually show some contrast so that we can all better learn. All right, but since I'm done with that, I think it's time to move into fundamental analysis. And I think a lot of people, I'm sure a lot of people are going to benefit from this analysis. They are going to benefit from this analysis. All right, so let's go. Okay, so as you can see, I'm using Share Invest. Different people have different platforms. For me, it's Share Investor. The other one that is also quite good is Y Charts. Now, I'm not endorsing them. I don't earn any commissions from them, but I have used them during the trial period, and it is really not bad. They have a lot of statistics there as well. But for me, my platform is our Share Investor. If you are a serious investor of stocks and equities, you need to get yourself a platform like that. Okay, all right. Now, today we're going to look at Bank of America, okay, and we're going to sort of compare it to JP Morgan, all right? So first of all, the first thing I always look at when I look at a company is its ability to generate cash flow. Is the cash flow of the company healthy or not? Okay, now, to know whether the cash flow of a company is healthy or not, all right, we look at certain metrics, okay? Now, we're going to come to all this later. Now, these are all stock prices. I'm not concerned with that. Okay, I am a business fundamentals guy. All these so-called change in profitability targets, change in price, all these things are basically market psychology, what the market thinks of the company's stock. Okay, now that is also important, but it is not as important, in my opinion, as the fundamentals of the company, which is basically, is the company healthy or not? Okay, is the product going? Are people buying their products? Okay, so first of all, we come here. All right, now first thing I want to see is this earnings per share. Okay, for those of you who do not know what's earnings per share, it's very, very simple. All right, for all the outstanding shares, okay, not including restricted shares, but not all authorized shares, all the outstanding shares, okay, net earnings divided by per outstanding share is earnings per share, okay? So earnings per share basically it's telling you whether the company, how much money the company is making, but it's not telling you cash flow, all right, because it just tells you one side of the story, which is the demand side of the story, okay? Are people still demanding for a company's products? But it doesn't tell you the cost, the supply side of the story, which is how much expenses, how much operational causes, how much operational expenses is the company spending every month. Okay, you need that part of the equation as well. Okay, so earnings per share is 290. Right, look at JP Morgan Chase is 11. All right, so definitely in terms of earnings per share, JP Morgan is much better. It's in terms of gross profitability, is much stronger. All right. Now next thing, we go to financials. Okay, so this is the full year profit and loss. Now times 000, which means times 1,000, which means whatever stats you are able to see below here, we have to multiply that by 1,000. All right. So this is the first part we want to see it. Okay. All right. Profit after tax. All right, it's about, this is 24 million times 1,000, which is about 2.4 B. Okay. Net earnings. Okay, about 1 B. Not too bad. Dividend per share. 245. Special dividend per share. Okay, gross dividend per share is also important. All right. It's important because you need to know how much the company is allocating towards dividends. If the money can be better used to grow the company, it should be used to grow the company. You shouldn't be investing in the stock because of just its dividends. Right? You buy into the shares of a company because you see long-term potential. You don't just buy into the shares of the company because you get high dividends. Okay? But of course, it's also important to note that sometimes it's not efficient allocating all your retained earnings towards growth, because sometimes growth creates value, sometimes growth destroys value. All right? It doesn't mean that just because I pump all my money, additional earnings, and I don't give a single cent of dividend, I pump all that money into marketing campaigns, growing the company, that's going to work out for the stock long term. Sometimes that doesn't really work. All right, it's better to give some money back. You retain more wealth in that sense if you didn't try and put all the money into marketing and growing the company, because sometimes some certain growth campaigns are not exactly creative. In other words, certain growth campaigns, they don't really contribute to an increase in wealth of the company. All right, we'll go more into that later. All right. In the future videos, but for now, let's just take a look. Okay, so these are the stats. Let's go down. Now, a few things I like to focus on is debt. Okay, debt too. There's a lot of stats here, but I just want to bring you guys to a few stats which I personally think is extremely important. Okay, first of all, return on equity, 9.38%. All right. So return on equity is basically all the money that the shareholders invested and the rate of return on their investment, to put it very in a layman term. That means if you have put in $50,000 every month, how much percentage of that $50,000 is generated for you as a shareholder. Okay, this doesn't take into account any break-even period. You could have broken even 10 years ago, but they will still be calculating this return on equity. Okay, because return on equity is important in the sense that it shows you, exactly how much cash flow the company is generating for its shareholders. Of course, you have to understand that shareholders' investment can regularly change. Shareholders can regularly pump in money and inject capital, and that equity size will grow, right? And also they could have just injected capital at the start and stopped injecting capital after that. It can happen both ways. But no matter whether it's at the start or afterwards, all of it is added together to produce this financial ratio called return on equity. Okay? So a high return on equity is a healthy sign because it shows that shareholders are getting their money back. The people who invested capital, they are still receiving money back. Okay, usually the average growth percentage is about 12. Anything below 12 is not good. Okay, anything above 15 is considered above average. All right, so 12 is not so good, but above 15 is good. All right, so you can see that for Bank of America, they only have a 9.3% return on equity based on last quarter earnings, right? So not that excellent as of now. Let's look at JP Morgan. Now, I always put two companies side to side to compare because you need to understand what is the industry average, what is the industry approximated values. All right, 12 and 15 is across all industries. Maybe for the banking sector, that's not a realistic number, but never mind. We'll look at JP Morgan. Wait, this is Bank of America. JP Morgan. Financials. Okay, so return on ROE, right here. So you can see JP Morgan achieved 12.249%, which is the average. Like I said, the average rate of return on equity is considered healthy. Okay? Now, so JP Morgan is definitely stronger in terms of these financials as compared to Bank of America. Let's continue. Now, the next thing I want to see is debt to cash flow. All right, debt to cash flow. Now, important, what is debt to cash flow? You have to understand what is X to Y. X is always taken as the unit 1. 1 is to X, 1 is to Y. So what this debt to cash flow matrix measures is for every $1 of debt incurred by the company, how much cash flow are they generating? Okay, it has to be positive. It cannot be 0 point something. Okay, because if it's 0 point something, it means that the company's cash flow cannot catch up or cannot keep up with the company's accrued debts. So it has to be more than 1. But how far? How far is it more than 1? Now that's the key question. Okay, so as you can see, JP Morgan, they achieve about 74.79. That means for every $1 of debt that the bank accrued, they have $74 worth of cash flow, operating cash flow. So that is healthy. That is healthy for now. All right. Now another thing, let's debt to cash flow is $24. So for every $1 of debt that Bank of America accrued, they have $24 worth of. Okay. Now, what other important ratios are there? Okay, there are other important. The other important ratio is debt to asset. Okay. Now, all these debt ratios that I call are important, especially when we are looking at a potential recession or depression, because the amount of debts accrued by a company, unless there's a bailout, I mean, assuming there's no bailout, okay, assuming the idea of a bailout, the idea of government intervention is not present, the ceteris paribus across all companies, okay, assuming that doesn't exist. Assuming that a bailout doesn't exist, debt ratios are very important in finding out whether a company can weather a recession, whether a company can survive a depression, okay? So, debt to asset means for every $1 of debt, how much assets, how many dollars of assets there are. So for Bank of America, you can tell that the latest one in March 2020, okay, they have 0.174. So for every $1 of debt, they have $0.174 of asset. So debt to asset is always expected to be less than 1. Very few companies have more than 1 debt to asset. Okay, the reason is because assets is just whatever value the company has in terms of its inventory and its data and all that, right? So all these assets are usually for banks, it's less than 1. In fact, for most companies, it's less than 1. Okay, but it's just a matter of extent, how much less than 1 it is. Okay. So look at JP Morgan. Debt to asset is 0.195. So in terms of debt to assets, both JP Morgan and Bank of America is about the same. It's about the same. Okay. Especially for banks, they borrow a lot. They do overnight borrowing, so overnight swaps. So it's very common for them to have a less than 1 debt to asset. In fact, like I said, for most companies, it's less than 1. All right. But please, when we say debt to asset, it's different from debt to cash flow. All right. So debt to asset does not indicate that the company is unable to pay off its debts just because its asset is less than $1. It doesn't mean that. Okay. It just means that the assets taken alone measures less than the debt. Okay. But it still does show or point towards the indication of whether a company is able to weather a recession, because during a recession there are chances where the company needs to sell off certain assets to pay for its debt. So the closer debt to asset ratio it is, the tighter it is, the more possible that assets will serve as a good hedge against debt, or has a good solvener, or has a good solvency provider for a company during times of recession. All right. Now, the next thing we want to know is operating cash flow to sales. Okay. So you can see over here, operating cash flow to sales is a metric that indicates a company's ability to generate cash from its sales. So when we talk about this, we have to understand that not every single company and not every single industry is the same. Certain companies may have sales, but they may not be able to generate cash. Why? Because sometimes, number one, it could be a delay effect. You close the sale in January, but you only get fully paid by April. Or you receive your first payment in April. That's number one. Number two is staggered payments. Not every customer is going to pay you the full sum, especially for IT, for tech companies. People don't pay 100% upfront, right? They pay maybe 30% for phase 1, 30% for phase 2, and then the remaining 30% or 60%, 40% in phase 3. So these are staggered payments, and it will affect your cash flow. All right. So you can see that for JP Morgan Chase, all right, the percentage is 5.974%. Okay, that means for every one sale close, all right, for every $1 of cash flow generated, it's generated from 5.9% of its sales. For every $1 of cash flow comes from 5.9% of its sales. All right. Now let's look at Bank of America. Operating cash flow to sales is a matrix that indicates, all right, so again, for how much cash flow is generated from how much sales. All right, so you can see that in terms of operating cash flow, Bank of America is much better. It's 15.62%. Okay, means that Bank of America is very efficient at generating cash flow from sales because it generates 15% of its cash flow, operating cash flow from sales, which is good. It means that for every sale close, they get cash flow quick. They are able to get the cash in faster. Whatever marketing programs they are using, whatever campaigns they are using, they are able to get the cash flow in much, much quicker. Okay, so that's why they have 15% for operating cash flow to sales. All right. So there's a lot of other matrix here. All right, but for today, I'm going to stop here. For now, I would say that JP Morgan, in terms of financial matrix, at least for the matrix that I examine, I feel that JP Morgan is a better investment choice. Okay, because for me, I look at business fundamentals. Of course, this is just financial matrix. You have to look at the leadership of the company. You have to look at the management. You have to look at what's happening recently. You have to look at the technical charts. You have to look at things like other factors, what other banks are doing. All these are other factors that need to go inside your analysis. But for now, looking at the financial matrix, I personally am in favor of JP Morgan as compared to Bank of America. All right, so that's all from me. Thank you very much. I see you in the next video.